going to be a big week with the banks reporting earnings, always an important event for Canadian investors. And of course, we're into the last month of the year, usually a great time for stocks. Let's get more from Kevin Headland, co-chief strategist at Manulife. Thanks very much indeed for joining us this morning, Kevin. Just remind us, I mean, December, usually pretty reliably a good month.
December is usually reliably one of the best months for the TSX and SP 500. Often we talk about a Santa Claus rally. Perhaps investors are a little exuberant and happy with the holiday season, and perhaps that helps move markets higher.
The bank earnings are coming out this week. What are you looking for here? What areas of weakness do you think might emerge in the banks?
We're actually very positive on the banks on this quarterly earnings announcements. Fundamentals remain very strong. When you look at the rates market, it has come down, which perhaps has facilitated some of the risk in the mortgage market. But when you go back to mortgages that were originated in 2020 and 21, the stress test rates were actually higher than the current 5-year fixed rate. So that perhaps has alleviated some of the stress there. We think loan loss provisions are perhaps going to come down once again, given the underlying economic fundamentals remain sound in Canada. So ultimately, it's not a phenomenal environment, but still very solid. And I think the banks will once again continue to announce very solid earnings, especially those that perhaps are related to capital markets. As the markets have been moving higher, of course, there perhaps is more trading, more activity in those markets, and then it helps support those lines of businesses for those banks.
The Canadian Bank Index, maybe we can put up a 5 or a 10-year chart, hit a record high on Friday. Do you think there's too much optimism about the banks? I mean, the economy is going through a soft patch. Growth isn't much more than 1%, for example.
Correct. We see below trend economic growth. The good news perhaps is at the current environment, we are avoiding the dreaded R word, recession. But yes, the economy is still in a sluggish patch. There still are some risks there. Ultimately, the banks have driven higher. Perhaps they were undervalued coming into this year. They have been one of the main drivers of TSX performance, along with gold and certain companies. There probably is still some sustainability for the banks moving forward, perhaps not to the same extent we've seen, but we don't see any trouble on the near-term horizon and necessarily for current stock prices for the banks.
What is your broad outlook for the Canadian markets this month as we close out 2025?
Yeah, we're still very optimistic. We could still, hit new record highs for the Canadian equity market, the TSX. There still, again, is some pretty good solid fundamentals there. Companies remain, in good shape. There are, as you said, economic weakness in certain areas of the market, something to pay attention to. But overall, I think we are still optimistic and constructive on TSX into this year and even into next year. Again, perhaps not the same rate of change and growth that we've seen in 2025, but in the near term, there doesn't seem to be any alarming issues that we should be avoiding the TSX on a whole. I would say that perhaps in this marketplace where you see valuation that has moved higher and perhaps the drivers of returns have been concentrated in certain sectors and certain companies, that is really points to an opportunity for active management to find perhaps dislocations in quality companies that perhaps are under-owned or under-loved at this point in the cycle. Are you
seeing some sectors, for example, unfairly neglected by investors?
On the TSX, of course, the sectors are so heterogeneous. It's hard to say what sectors we like. But definitely there are some companies that are attractive here. We don't want to be necessarily overweighting Canada on a geographic footprint, but there remain some solid opportunities there. And our portfolio managers that are focused on Canadian equities are still finding some great opportunities that the market perhaps hasn't moved or shown some positivity to just as much as we would expect just yet.
What about bonds? Your balanced portfolio managers, are they overweighting or underweighting bonds?
We're actually currently underweight fixed income when you look at a 60-40 strategy, but not perhaps underweight as you might expect. There really is no reason to increase fixed income to a perhaps above neutral weight. When I say underweight, I'm saying very barely underweight. A 60-40 portfolio is perhaps 65-35. There's still some attractiveness in equities. But you still want to pay attention to bonds. I think it's important for those investors who have shied away from fixed income in their portfolios over the last couple of years because equities have done so well. This is a great time to review your portfolio coming into 2026, understand how much risk you want to be taking. And sometimes when equities run, you actually are taking more unintended risk than you expect to. And as I've said many times with advisors across Canada, most clients don't, or probably no clients have, 15, 20% target rates of return in their financial plans. It's important to understand risk reward at this point in the cycle.
Kevin, thank you very much indeed.
Thank you.
Kevin Headland, co-chief strategist at Manulife.